it's Friday morning, which means that it is time to check in with CEO of Ocean Audit, Steve Fereirra, about what's going on in the ocean shipping world. Steve, thank you for joining us today. And top of everybody's mind is COVID in China and what the heck is going on.
Hey, Kaylee. Hey, Anthony. Good morning. Well, it's certainly a mixed message this morning out of this afternoon out of Shenzhen and Shanghai. Certainly, I think the continued Chinese policy of lockdown, we're hearing some experts thinking that that will actually be relaxed and maybe the problem is not as bad as we thought. But we are getting sporadic updates from manufacturers and agents showing that activity has really kind of slowed down quite significantly. So it'll definitely be, I think, a slingshot effect once we do get past some of the closures that are happening right now.
It's interesting to me, Steve, because the initial reports were like the city's shutting down around the port. We've got warehouses shutting down, manufacturing plants saying, okay, we're going to close operations, but the port itself was still open and operating. Can you give us any clearance on if there's like a disconnect in regulation there, or do we just truly not know?
Well, a port is almost like a nuclear power plant, right, Kaylee? I think, you still have to have some of it moving in order to keep the infrastructure and, not total gridlock. So in a nominal basis, things do move, albeit quite slowly, repositioning of vessels, preparation of container cranes and gangs. But, certainly with a skeleton staff, you can't expect much throughput to be happening. So it's not like it just closes and it doesn't move. It just really reacts quite slowly.
And Steve, when we're looking at this, really the shutdown that we were hearing from China, are there any, I want to say positives, but stressors now that they're going to be taken off of the supply chain as like a little bit of a breather of like, okay, maybe there could be some catch up here? Or are you seeing like, hey, there's just going to be a complete buildup and things that are just waiting to go, and it's just going to be another wave of just really chaos here coming up?
Well, Anthony, Gene Soroka from Port of Los Angeles said that, there's another flotilla of ships coming in with the Chinese New Year goods that we're expecting, some 40 to 50 vessels, focusing in on Port of Los Angeles. And I think one of the things that was really shocking to me, at least, was Maersk Line putting out a customer advisory yesterday. They're being brutally honest about the amount of waiting time. I'm just looking here at my notes. For example, 36 days for a berth for their TP2 service, their high-speed TP8 service, 41 days waiting for a berth. But even more so, if you look at these rail density figures in Long Beach and LA, they're well over 100%. So I think that, people put on a good face and try to mask the severity of the problem. But I do believe we're going to get hit with another wave, and then COVID in China will present itself with an incredible blanketing, kind of like one of those northeast snowstorms that just kind of drops, 15 inches at once. So I think we're not out of the woods by a stretch at all here. And on top of that, we really have the natural peak season, coming up in May and June. So it looks like importers are in for another container getting round.
So, Steve, the interesting thing about the West Coast, we mentioned if there's going to be kind of any alleviation in the stress right now from what's going on in China. We just got a press release from the Pacific Merchant Shipping Association about 30 minutes ago that said container dwell times improved for cargo leaving by truck, but they increased in time for rail cargo, which is interesting to watch. And for San Pedro imports, truck terminals down from 6.9 days in February to 5.8 days, but cargo leaving on rail almost doubling dwell times up to 5.2 days from 3.9 days. And this is kind of interesting to see, right? Because for a while, intermodal was kind of the release valve.
Yeah, I think what's happening is, and it kind of goes into, I think, inventories as well. We see that we see less durable goods, goods that would last three or more years, like refrigerators or washers and dryers or goods of that nature. It seems like that kind of wave went in, and now we're seeing more of a wave of, retailers and e-commerce folks replenishing, which, tends to really alleviate or put more pressure, on that that rail portion. So this may be a shift of commodity rebalancing, because I think the jury is really still out. I mean, there's somebody who will say that, yeah, hey, we still have a depressed inventory level. And then others will say, oh, no, not at all. Inventory levels have really migrated up nicely. But I think more for the durable goods versus the kind of e-commerce replenishment materials.
And Steve, speaking of replenishment, can you talk to some of maybe Walmart's plans for replenishment after that distribution center fire happened in Plainfield, Indiana?
Well, the Plainfield fire was, a disaster, right? Thank God. It seems like the initial reports is everyone's okay. That's the most important thing. But that's a 1.2 million square foot facility, and one of the many warehouses or DCs that Walmart has, and that, obviously in that heartland. So I think that the lights are on in Bentonville, certainly trying to figure out how to either restock and replenish that. But my thinking is probably it turns a switch on for them to start trying to activate another potential charter, perhaps even using their own 53-foot new build. So I would expect to see some activity very soon on Walmart's replenishment strategy on inventory that might have been lost there, Anthony.
And while we're talking about import inventories, there's kind of this debate right now: are inventories high or inventories low? Where are we sitting with this, and how can you tell who's right in this situation?
Yeah, it's like we just talked about before on the dishwashers and the washers and dryers. I really have seen that kind of slow down a bit. I think that certainly the LGs and the Samsungs and the Whirlpools wanted to get a lot of that merchandise in as quick as possible. A lot of them opted for charters to do that. Right now, it's really, I think, the medium tier importer, the importer that has, 2,500, 5,000, 8,000 containers a year. I think they're now looking kind of to get that made up before these new ocean contracts go into full force, where they're actually, paying double. So I think they're trying to get some relief from the old deals, and at the same time trying to play that spot market. But that spot market rate, contrary to what one of my friends and good experts, Lars Jensen, said, I don't see that spot rate dropping as dramatically as some experts would say. So it's going to, obviously inhibit, the amount of types of goods that can come in that can sustain that kind of price point on a landed cost basis.
And Steve, interested to hear your take around some of these, this story here. The latest one being with Hapag's confidential detention settlement this week that happened.
Well, this just happened 2 days ago. I was looking at the FMC footnotes on the different cases that are actively in engagement at the Federal Maritime Commission. And I do believe that as I've been telling the trade for the last week or 2 or 3 weeks, that detention costs are now, in my humble opinion, one of the easier ones to push back against. And now I don't have terms of this particular confidential settlement, but a major trucking company engaged in refrigerated containers had alleged that there was $250,000 in detention invoices that Hapag had billed them inadvertently. And because they couldn't get the containers returned, Hapag wouldn't accept them, and so on and so forth. So the case has been settled. It's a confidential settlement. But I think in cases like this, it wouldn't be surprising at all to me to see half of the amount, withdrawn, or a quarter of the amount withdrawn, or maybe even 3/4 of the amount. So I think that the thing that beneficial cargo owners need to really focus on in the next upcoming week is how to resolve their detention issues. The FMC is looking long and hard at this, and I think it's one of the best areas of attack from the BCO import perspective.
All right, Steve, thank you so much for joining us today. As always, you've got Navigate B2B this afternoon. What's on tap for your show?
We're going to really dive into how this detention strategy is a $5 billion a year issue, Kaylee. So we're going to help our BCO friends, followers, and fans of Navigate reduce some of those costs today, live on Navigate B2B.
Awesome, Steve. Thank you so much for joining us. We'll talk to you next week.
Thanks. Bye.
All right, we're going to take one last quick break this morning. We'll be back to wrap up with a second check of your headlines and another look at weather.